Inflation doesn't steal your money in one dramatic moment. It steals a little today, a little tomorrow, a little next month. And because you barely notice each loss, you don't realize how much purchasing power has disappeared until one day, $100 doesn't feel like $100 anymore. And here's the uncomfortable part. For a household spending tens of thousands of dollars a year, the financial impact of inflation can easily reach tens of thousands of dollars over time. That's why the headline sounds outrageous. Inflation is quietly stealing $50,000 from you, not necessarily as a literal $50,000 annual charge, but through something far more dangerous, the silent destruction of purchasing power. And if your money isn't growing faster than inflation, you're losing ground even when your bank balance keeps going up. So let's break down what's really happening and what you can actually do about it. The inflation illusion. Imagine you earn $80,000 today. Next year, you still earn $80,000. Your paycheck looks the same. You might even feel financially stable. But if prices rise, that $80,000 buys less. That's the inflation illusion. Your number hasn't changed. Your wealth has. The Bureau of Labor Statistics explains that purchasing power is inversely related to the consumer price index. When prices rise, the purchasing power of each dollar falls. And this is why inflation can be more dangerous than a market crash for people who aren't paying attention. A market crash is visible. Your investment account suddenly drops. You panic. You notice. Inflation is different. The 2% problem. You may have heard that the Federal Reserve aims for approximately 2% inflation over the longer run. That sounds harmless. 2%? What's the big deal? The problem is compounding. At 2% annual inflation, prices don't simply rise 20% over 10 years. They compound. After 10 years, something costing $100 today would cost roughly $122. After 20 years, roughly $149. After 30 years, roughly $181. And that's assuming inflation averages only 2%. But recent American history has shown that inflation can run considerably higher. In June 2026, the U.S. Consumer Price Index was 3.5% higher than a year earlier. The Federal Reserve's 2% target, therefore, isn't a guarantee that prices will rise by only 2%. It's a long-term policy goal, and the difference matters enormously. Here's where the $50,000 disappears. Let's say your household spends $100,000 every year. If your overall cost of living rises by 3%, maintaining roughly the same lifestyle requires about $3,000 more the following year. That doesn't sound terrifying, but repeat it. Food, housing, insurance, transportation, healthcare, utilities, education, entertainment, subscriptions, everything starts stacking together. Over years, the additional money required to maintain the same standard of living can become enormous. That's where the headline number comes from. Not because the government sends you an invoice for $50,000, not because inflation literally removes $50,000 from your bank account every year, but because higher prices can force a household to spend tens of thousands more over time simply to purchase a similar basket of goods and services. And there's another problem. Your income may not rise at the same speed. That's when inflation becomes a lifestyle problem. The worst place to hide now. Let's talk about cash. Cash feels safe. That's why people love it. You see the number. You know exactly how much you have. No stock market charts are moving up and down. No complicated investment statements. Just money sitting there. But cash has one enemy: time. Suppose inflation averages 3%. You have $100,000 sitting in an account earning nothing, essentially. After 10 years, you still see approximately $100,000. But that money has only the purchasing power of roughly $74,000 in today's dollars. The number stayed the same. The buying power didn't. That's why the question shouldn't simply be, how much money do I have? It should be, how much can my money buy? The first defense, stop thinking in nominal dollars. This is one of the most important financial concepts most people never learn. There are nominal returns, and there are real returns. Imagine your investment earns 7%. Sounds great. But inflation is 3%. Your approximate return after inflation is not 7%. It's closer to 4% before taxes, fees, and other effects. That 4% is much closer to what actually matters for your purchasing power, because the goal isn't to make your account balance look bigger. The goal is to make your economic life bigger. The second defense. Own productive assets. Historically, one of the major ways investors have attempted to protect long-term purchasing power is by owning productive assets. Businesses, stocks, real estate, and other assets capable of generating income or appreciating over time. This doesn't mean every stock goes up. It doesn't mean real estate is always a good investment. And it certainly doesn't mean you should blindly buy anything because someone online calls it an inflation hedge. It means understanding a basic principle. If prices and revenues in the economy rise over time, productive assets can potentially participate in that growth, but they also carry risk. That's why diversification matters. The third defense, make your income fight inflation. Here's a strategy people often overlook. Don't only protect your savings, protect your earning power. If inflation rises 3% but your income never changes, you're effectively taking a pay cut in real terms. That's why skills can be an inflation defense. Learning technology, improving your professional qualifications, building a business, negotiating raises, creating additional income streams. The more valuable your skills become, the more opportunities you may have to increase income faster than rising prices. And unlike a savings account, your earning ability can potentially grow for decades. The fourth defense, don't let lifestyle inflation eat your raises. There's another form of inflation that doesn't come from the government or the economy. It comes from us. You get a raise. Your lifestyle gets a raise too. A bigger apartment, a newer car, more subscriptions, more restaurants, more expensive vacations, and suddenly your 10% raise has disappeared. This is called lifestyle inflation, and it can be just as destructive as rising prices. The solution isn't necessarily to stop enjoying your money, it's to make sure that when income rises, your savings and investments rise too. If your income increases by $10,000, don't automatically allow your spending to increase by $10,000. Let part of that raise buy something more valuable: future freedom. The fifth defense: understand your personal inflation rate. Here's something else most people miss. There isn't one inflation rate that perfectly describes everyone's life. The official CPI is an average measure of prices across a broad basket of goods and services, but your personal spending may look completely different. If you own a home with a fixed mortgage, your experience can differ from a renter facing rising rents. If you drive a lot, gasoline matters more. If you have children, education and childcare may matter more. If healthcare represents a large portion of your spending, your personal inflation experience can be very different. So instead of obsessing over one national number, calculate your own. Look at what you spent last year, then compare it with what the same lifestyle costs today. That's your reality. The biggest inflation mistake isn't necessarily owning too much cash. It's believing that because your wealth is increasing numerically, you're automatically becoming wealthier. Imagine someone has $500,000 today. 10 years later, they have $650,000. Sounds like success. But what if prices increased dramatically during that period? Their account grew. Their purchasing power might not have grown nearly as much. This is why wealthy investors obsess over real returns. They don't just ask, how much did I make? They ask, how much did I make after inflation? That question changes everything. So, can you actually stop inflation? No. You cannot personally stop inflation. You can't control Federal Reserve policy. You can't control oil prices. You can't control global supply chains. You can't control government spending. You can't control geopolitical shocks. But you can control your response. You can avoid keeping excessive long-term wealth in assets that consistently lose purchasing power. You can invest according to your risk tolerance and time horizon. You can increase your earning power. You can keep lifestyle inflation under control. You can diversify. And most importantly, you can stop thinking of inflation as someone else's problem. Because inflation doesn't care whether you are rich or poor. It simply changes what your money can buy. So next time you check your bank account, don't just ask, how much do I have? Ask, what will it actually buy 10 years from now? Because inflation doesn't have to take your money. It only has to make it worth less. And if your money isn't keeping up, you could end up with more dollars, but less freedom. If this video helped you see inflation differently, like, subscribe, and share it with someone who needs to hear this. And tell us in the comments, is inflation the biggest hidden threat to your wealth, or is the real problem failing to make your money work for you? Because prices will keep changing. The question is, will your money keep up?